What is up, everybody? Welcome back to the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host here, Kyle Ryan. Today, we are going to talk about tax planning for 2023. And this is something that we really like to make a differentiation on is there's tax preparation and filing, and there's tax planning, right? And there's a major difference here because tax preparation and filing is just kind of gathering documents, 1099s, W-2s, making sure that you're actually filing and sending out your tax forms to the IRS when tax time comes. Tax planning is the process of being really strategic in the front end, the beforehand of actually, filing those taxes and trying to maximize your situation to the best of your ability. And before we get to that, Kyle, just kind of wanted to mention here, got the Eagles shirt on. Would love to hear your take on Eagles Giants. We're filming this the right before the weekend game, so would love to kind of get your take as a Philly guy.
Very confident in the win. Don't love the spread, but hopefully by the time this airs, we'll be talking about the next Birds game.
Exactly, I love it. I wish I would have worn my Chiefs shirt, but I didn't. Just crossed my mind, but I'm still super confident. Chiefs are going to beat the Jags here on Saturday. Trevor Lawrence made a major mistake in the presser here this week, saying that Arrowhead wasn't very loud. So I've got a feeling he's going to have a very loud and rude awakening when he walks out of that tunnel on Saturday. So
that was a rookie mistake. And thank you for saving me the pain of wearing Chiefs jersey as a Broncos fan. I'm just glad I have my local team to support.
Yeah. Absolutely. Absolutely. Well, back to tax planning here. We have a couple of things that we really just wanted to hit on as far as some things to consider, things to plan for, and also just like some opportunities to maybe take advantage of. Kyle, I'd love to kind of, have you kick us off here on your thoughts.
Yeah, and Thomas, I mean, you hit it really well. I always, not to use another sports analogy, but when you're doing tax preparation, you're handing in your scorecard. April 15th, when you do your taxes, you're not making changes. It's what's done. Tax planning is to make sure that you don't end up owing. There's no surprises come the time that you file your taxes. So tax planning, it takes on a lot of different, there's a lot of different ways to go about tax planning. And there's a lot of different considerations to have. Where I typically start with a client that I meet with, especially when it comes to tax planning, is just, no one likes surprises come April, and no one likes owing the government nor getting penalized. So, a good place to start, especially for a W-2 employee, is just reviewing their pay stub and making sure that they're withholding the proper amount. Because again, if you're not withholding the proper amount, you're going to end up owing at the end of the year come April when you file your taxes. And if you get ahead of it early, it takes a much smaller adjustment to make that change and get ahead of the situation than waiting until the end of the year and saying, oh my gosh, I'm going to owe a boatload in taxes and penalties. What can I do? Yeah. So, the first thing is always, review pay stubs and just make sure you're getting ahead of your tax withholding.
Yeah, absolutely. And I've seen it even on a very grand scale, with some of the athletes that I work with. And it's just kind of this idea that people have in their mind and the fact that their company's just going to be perfect every time. And they're never going to make a mistake on your tax withholding, because I've seen major lacks in tax withholding on some of my athletes, incomes. And so it's something that we absolutely review on a frequent basis. And, kind of transitioning into that, it's, reviewing withholding, but also looking for opportunities as well. We were kind of having an offline conversation about, looking at what your projected income for this year is, and seeing if you have the ability to contribute to a Roth IRA. Maxing out that Roth is always a really good opportunity if you have the cash flow to do so. And it's also kind of reviewing 401k contributions, because one of the things that I always challenge the people that I work with is unless you're already contributing just a massive amount to your 401k, is if you're just kind of getting started out, push yourself to contribute 1 extra percent more at the least every year. Because if you're starting at 3% and your income goes up and you just never change that, obviously the dollar amount goes up, but you're kind of cheating yourself in the ability to not have to contribute more, and you're not pushing yourself in that part of your life. And depending on where you're at, especially if you're doing pre-tax contributions, you're getting even more of a tax deduction in that given year. So also just kind of reviewing 401k contributions for me is a big ticket item that we like to review as well.
Again, that's a really good point. And typically, in my experience, is if you're making more money and you don't pay yourself first in savings and investing, you're going to find a way to spend that money on something that's not for your future. So having that automatic step up in contribution rate, which, as you know, we just had our episode last week on Secure 2.0, new plans that are going to be created this year and moving forward, they're going to automatically enroll employees in 3% contributions. And each year it's going to get stepped up 1% till they reach, I believe it's 6 or 10.
Yeah.
So I love that idea. You know, you won't notice 1 extra% of your pay going toward the 401k. And if you don't notice it, then that's just even better for the years down the line when you eventually take it out.
Yeah.
And you hit on a couple different things there, you know, mentioning the income limitations for the Roth. You know, it's just really important to be aware of your individual tax circumstances. You know, if you're married, you can make more and still qualify to contribute to a Roth. Whereas if you're single, the income limitation is lower, so you might not be able to contribute to a Roth. So if you're considering it, you know, speak with a tax planner, a financial advisor, and just, you know, make sure that you're able to make those contributions, because undoing them is no fun.
Yeah, absolutely. You know, and it kind of, you know, goes on the Roth side of the conversation we've had about, you know, the opportunity, if you have the ability within your retirement plan to make those, you know, backdoor Roth contributions as well, especially for high income earners, is, you know, if you're contributing up to that max and you still have extra cash flow available and you still want to make more Roth contributions, depending on if the plan that you're a part of allows for it, you can make what's called after tax contributions, which are essentially Roth contributions, and those monies go into the after tax account. And then again, depending on the stipulations of your plan document, you might have the ability to just convert those after tax contributions to the Roth account every year. And you're essentially super funding a Roth in comparison to some of the other opportunities that are available that have a much more limited scope and scale on how much you can contribute.
Yeah, you know, we've got plenty of people who, you know, they've got income far too high to contribute to a Roth. So what they're doing is they're maxing out their 401k contributions, they're getting an employer match, and then they're stopping there, not realizing that, you know, you can get tens of thousands of extra dollars into that Roth side of the equation, as you mentioned, as long as your plan allows for it, which is a big if. Not all plans allow for after-tax contributions or conversions within the plan, and a lot of the other things that are required to make this a worthwhile strategy. So again, if you know, if you got money spilling out of your pockets and you want to fully contribute to your Roth 401k, your 401k in general, this is a really good opportunity to do so.
Yeah, absolutely. You know, and I think that's, you know, a kind of a nice little pat on the back for advisors like us is this is one of the, you know, 100+ reasons why having an advisor, especially when you're making high income, regardless of your asset level, why having an advisor to, you know, discuss these types of conversations and strategies with is so important, is because if you don't know the answer, you can just send us the summary plan description, you know, on the 401k. We can read through it and then educate you on the options that you have available on your plan, where, you know, reading through that financial jargon for you might, you know, put you to sleep at 2 o'clock on a Friday afternoon. You know, you don't want to do that. Let us do that. You know,
Yeah.
that's why we're here. And so, you know, I think that's just kind of, you know, that additional piece where, you know, having an advisor to, you know, make those types of discussions available is so important.
Yeah, you'll never know what you find reviewing those too. You know, some plans allow lots of really cool provisions. But before we move on, I want to backpedal really quick, if we can, Thomas, to
Yep.
the pay stub conversation. You know, just for the understanding of how they calculate how much to withhold from your pay stub. You know, every time you sign up for a new company in the 401k, they're going to ask you to fill out what's called a W-9, which is income information. So I've ran into this a lot of times, Thomas. I'm sure you have, where if someone has, say, 2 jobs, what they're doing is your employer is looking at the income from that job for you and withholding the proper amount, so that you know, if you're making, say, 30 grand at one job and 30 grand at another job, they're both going to be withholding as if you only ever made 30 grand. And you're going to end up owing taxes in that circumstance, because you're going to be pushing yourself beyond tax brackets that they're accounting for.
Yeah.
So it's really important when you have someone, you know, with 2 W-2 jobs, with multiple pay stubs, a husband and a wife coordinating it, to just make sure that, you know, the proper amounts withheld. And again, I just wanted to come back to that and make sure that, you know, the understanding where they get this number from is accurate. So I just think it's really important to emphasize, make sure you're withholding the right amount as early as you can in the year, because it's just harder to fix it later on.
Yeah, and making sure, you know, as you're building out your family too, adding the number of dependents on that W-9 as well.
Great point.
Because I've seen that multiple times where if we have, working with a young family who has maybe had, I don't know, anywhere from one to maybe three children in a short, span of time, and they're not updating those W-9s to reflect that, they're leaving money off the table for dependency credits.
And absolutely, and that swings right into, it's a pretty good pivot into talking about, if you have kids in general, what are other ways that you can plan to, save on your taxes? Be
Yeah.
aware of the child tax credit,
Mhm.
the income limitations to that. Obviously you're not going to go to your boss and say, hey, I make too much money, pay me less so that I can get this credit.
Yeah.
But just being aware of the income limitations for, the tax incentives of having children. The child tax credit, you can contribute to 529 plans for your child's education and get a state tax deduction depending on the state you live in, which is also an important note there. But yeah, there's a lot of things that you could do if you have children that are actually tax incentives,
Yeah.
not that you have kids as a tax incentive, but there are nice benefits.
Yeah. Yeah, absolutely. And kind of transitioning over to, I would kind of consider like the opposite side is kind of that 1099 individual, the business owner side of things from a tax planning perspective. One of the biggest things that I'm working on right now, and it as an advisor, sometimes it's tough to take your advisor hat off, but realizing from a general public perspective, some of the things that are just never taught when you're starting a business, things of that nature. But I've seen so many people recently that I've started working with that have a sole prop business, or they just set up an LLC and they don't have business checking accounts. They don't have a specific credit card that's used only for businesses. And, one of the things that I would really recommend in this year is if you are a 1099 individual, or if you are a business owner, and you're required to pay quarterly taxes, make sure that you've got multiple business checking or savings accounts that have specific parameters or reasons for why that account is open, because obviously you're going to have your main account where all revenue is going into, and then one of the accounts that I really like having people set up is a quarterly estimated payments account, because if you're working with the right tax professional, CPA, EA, whoever that may be, they're going to be able to project what your quarterly federal and state tax withholdings are going to need to be, what those payments are going to look like. And we can help develop a cash flow strategy where every time you're receiving revenue, a portion of those monies are going into that quarterly estimated tax payments bucket, that are there to where whenever those tax payment dates are, all you need to do is just pay that money into that, out of that account, and it's squared away. Because if you don't do that, like you said earlier, you're going to be able to, it's very easy to use what's in the checking account. And if you don't, coordinate that estimated tax money, it can definitely be a really, excuse me, really hurtful, on your cash flow conversation.
Yeah, yeah, the people who typically end up owing the most are those 1090, the sole proprietors, the 1099 individuals who just don't know how much they need to save, right? If you make 100 grand in a given year and you're going to owe, say, $20,000 in taxes, you can't wait. You can't not pay the government all year and then pay them in April. They're going to penalize you. They want a certain amount of money as you go. So you have to set up what's called quarterly estimated payments, where you're paying them each quarter to keep yourself, in check with the IRS.
Yeah.
So it's really important to understand that. Thank you for bringing that up. Some of the biggest impacts we can have on tax planning is with these self-employed individuals, because, they're kind of getting hosed from a tax perspective, right? You're paying both sides of Social Security tax, which is another 7.65% on top of what a W-2 employee would make, right?
Mhm.
So there are really, really special tax considerations to make. A lot of self-employed individuals, we typically recommend the SEP IRA for those reasons, because you get to write off that higher taxable income. So yeah, especially as a business, and you got to track your business expenses, right? We always call it an escrow account. An escrow just means you're saving it for later, essentially. So if you know that 20% of your income is going to go to taxes, and you get paid 10 grand each month, send 2,000 into your escrow account so that each quarter you have money and you don't have to dip into the savings account to pay taxes.
Yeah. Yeah, absolutely. And it, kind of on the opposite end of the SEP is the solo 401k. What we have a lot of people do, if they've got a solo 401k, or if it's a small business that, maybe has, a 4 to 5 person 401k in it. We also set up an account to have cash flow go towards for an end of the year profit share. as well. That's a great way for the business to throw money into the, employees' retirement accounts, and you can do that on a tax deductible basis, right? So it's always a great opportunity that we can utilize as, either a major profit sharing contribution at the end of the year, or it's something that we can utilize to push over to cash flow if there is a need.
Yeah.
Yeah.
Yeah, just make sure you have multiple accounts. Mental accounting is difficult, so having different accounts set up for different purposes is really powerful, that I found in my experience. And two other things, quick notes, if you have an HSA, those are tax deductible. They grow tax free if they're used for qualified medical expenses. You don't pay taxes on the growth. An HSA is a wonderful way to reduce your tax liability as well. And then the only other thing I'd say is, they've recently come out with a lot of credits for EV, electric vehicles and solar credits. So, if that applies to you, just be aware of it, work with an accountant to make sure that everything is set up accordingly, and that, the government isn't one of your primary beneficiaries and not getting a single dollar more than they need to.
Yeah, absolutely. And on HSA, a topic that of conversation that's come up a lot with me recently with some younger couples that I work with is the individual, maybe one of the spouses has an HSA opportunity, with their job, but the other spouse doesn't have an HSA opportunity. And within the plan description of the HSA that's available, it only allows for single contributions, because one of the things you really want to make sure is you're not over contributing to that HSA, because there are penalties for that, just as if you'd be contributing, too much to an IRA. And you really want to make sure that you're looking at, hey, if my plan only allows for, a single selection on the HSA, I need to be contributing up to that maximum amount, versus if it's a joint HSA, that I can contribute just a little bit more. And so just making sure that you understand kind of what that code looks like and how much you have available is super important. And then on the credit side, absolutely. And, we're looking at this with a client right now, an influencer on TikTok that we work with, and he needs a new car. And, we've been looking at Teslas here actually just this week. Because you can get up to, depending on your income and depending on, the MSRP value of the car, you can get up to 7,500 in tax credits, every time you purchase a vehicle like that. And that's a huge advantage, because if you owe $10,000 in taxes to the government and you have a $7,500 credit, you just wiped off, 3/4 of that tax bill, right? You're only paying 2,500 to the government now. And, that just kind of warrants that conversation that we had recently about the difference between deductions and credits, how
Yes.
much better credits are.
Yep. I love everything you said. I think you covered it all really well. And yeah, just being aware of these issues is going to be the best way to stay on top of them.
Yeah. And I'd say, just to kind of close, we did want this to be a little bit of a shorter episode, but if you're not sure if these opportunities are available to you, reach out to us.
Yep.
That's what we're here for. And I think that's why we do this podcast too, is we want to utilize this podcast to put out content that we think is helpful to people. And if that content is helpful to you, we want you to reach out so that we can work with you and better your situation as well. So if you guys have questions, if something sounds interesting that you might want to take advantage of, but you might need a little bit of help on figuring out how to take advantage of it, reach out to us, and we'd love to, create an opportunity where we can work together and, make your situation the best that it can possibly be. So, that'll wrap up this episode. Kyle, if you have anything else, really appreciate you guys watching, listening, maybe doing a little bit of both, and looking forward to the next episode.